Hey, Cashflow Ninjas, real quick before we jump into today's episode. I've been asked by many people recently, what has been the one thing that has made all the difference on my journey as a business owner and investor? I started businesses and I've invested in businesses. I've invested in single family real estate, multifamily real estate. I still have a sizable portfolio of multifamily real estate, historic resorts, mobile home parks, oil and gas, life settlements, gold and silver, Bitcoin and cryptocurrencies. I could go on. But the one thing that has changed the financial trajectory for myself and my family has been infinite banking. Yes, you heard that correctly. That is the number one thing I've done over the past 2 decades that have made the single biggest difference. And it's not even close. Setting up and building out a family banking system using infinite banking has enabled me to create my own financial system. This year, it has allowed me to focus and not pay attention to all the chaos in the global economy and global financial markets. I really don't pay attention to all the noise about tariffs, trade wars, markets violently going down and then going back up, or interest rates skyrocketing and wrecking real estate deals and other alternative investment deals. Do not be beholden to other systems. Create your own system. If you're interested in working with me and my team at Producers Wealth to set up your own banking system or your own business and family banking system, then go to getwealthyforsure.com. That's getwealthyforsure.com. When you go to getwealthyforsure.com, you can request a free copy of my best-selling book, Get Wealthy for Sure. Only pay for shipping. You can also watch all of our presentations and schedule a call to explore infinite banking options with me and my team. You don't have to be powerless amidst the chaos. You too can have a financial strategy that provides certainty, predictability, and clarity. You and your family can also get wealthy for sure. Go to getwealthyforsure.com to start your journey today.
The world is going through changes. Changes happening at a speed that we have never seen before. This is leading to disruption, chaos, panic, fear, hysteria, and a turbulent economy and marketplace. How do you protect your wealth in a turbulent world? How do you invest for cash flow in alternative assets to escape the rat race in times of uncertainty? How do you decentralize yourself, your family, your community, your business, and your investments to become sovereign and escape the matrix? If you are looking for strategies, tactics, and techniques to escape the rat race and matrix, you are in the right place. My name is MC Laubscher, and this is Cashflow Ninja.
This is Cashflow Ninja. I'm MC Laubscher. Thank you so much for joining me for another episode and spending your most valuable resource, your time, once again with me on the show today. Everything Cashflow Ninja is at cashflowninja.com. That's cashflowninja.com. We've got over 1,000 podcasts, 4 books, reports, webinars, and much, much more. And don't forget to subscribe to the #1 newsletter in the alternative wealth strategy and alternative asset investing space, the Wealth Dojo. You could subscribe to the Wealth Dojo by going to cashflowninja.com/subscribe. I've got a fantastic show for you today. I'm joined by Chris Macintosh. He writes a fantastic newsletter. I would highly recommend you sign up for it at capitalistexploits.at. And he also has a paid newsletter, which is extremely insightful and valuable. If you are an investor and trying to navigate this crazy spinning ball of dirt that we're operating on right now,
I highly recommend Chris's work. Chris Macintosh has been on the show before, providing a ton of insights and always a ton of value. You could check out all of his previous episodes by going to cashflowninja.com and just type in Chris Macintosh. Chris, great to see you.
It's always good to be back, mate. It's been far too long, and I think since we last spoke, you've grown more of a beard. So you're looking good, man.
A little bit
Looking
of a
manly.
beard, some hair, a bit that I lost with my daughter. So the hair's on the head for now. But yeah, great to catch up. Love your work. Continue to follow your work at Capitalist Exploits, and then also, listening to all the ideas that you continue to share that you help your clients with at Glenorchy Capital, right?
Yeah, that's right.
Yeah, apparently a beautiful place. I know someone that's actually been there, and I think I mentioned I was going to have a conversation with you, and I said, "Oh, here's a firm called Glenorchy," and they go, "Oh, it's a beautiful place, beautiful part of the world." So, but great to have you on. As far as investing minds, someone that does an analysis just of the globe and everything inside of it that affects money, investment, business, and so forth. You're right up there with the top. So I'm very interested to see where we're all right now. What are some of the main themes that you are seeing in the world right now that you're paying attention to?
Main themes. Well, I think we believe that we are in a capital rotation cycle. We've been in it for some time, and what happens in these cycles is that your capital rotates from growth assets and bonds into hard assets. So we've had previous examples of these things taking place, but that certainly seems to be the case now, right? So we have gold has been one of the first movers, right? So you see gold moving, and it's outperformed most everything for the last couple of years. It has not outperformed two particular metrics, one being the S&P and the other being the NASDAQ. So we'll get into that in a minute. But almost against every other relative measure you want to take, whether it be the Dow, whether it be the CPI, whether it be the dollar index, money supply, any of these sorts of things, gold has outperformed those. Now, increasingly, silver is moving in conjunction, and so silver is catching up. Platinum is moving, and so you get these rotations, and they sort of whisper at you at the beginning, and then everything starts moving. And ultimately, this is how bull and bear markets function. There's the old adage, which is that markets grow in pessimism. What's it? They grow in pessimism, and they die in euphoria. And I can't remember what the middle one is, but I should do. My brain's not functioning early in the morning. But so, you have human psychology will show itself, and it's showing itself now in terms of the sort of mania, if you will, that absolute euphoria. And we're seeing that in the Mag 7 in particular and AI stocks. Now, whether that's over the last couple of weeks, that's sort of come off the boil a little bit, whether that is the beginning of the end for that or not, I have no idea. What I do know is that the concentration of capital in those markets is at extreme levels. It doesn't make sense. AI is essentially a revenue-free business, and revenue-free businesses tend to not last. Well, they last as long as there is some other conduit for the capital to come in that is divorced from fundamentals. In other words, where you've got a business that operates and it makes money, participants want to also make money. So they go, oh, can I have a piece of that business? If you're making money, I can make money alongside you. I will give you some of my capital so we can grow this particular business, and I will share in the profits, right? Whether it's a flower seller on the side of the road, coffee trader, whatever it is, we have a profitable business and you can expand the profitability or you could expand the size, then there's an ability to participate in that and that revenue flow. But it comes down to revenue and profitability. We don't have that today. We don't have that in AI in general. Now, that there are, of course, the hyperscalers, which are profitable companies. This is the Googles and the Microsofts and so on and so forth. But keep in mind that a lot of this capital that, or this component of their business, which is related to AI, is unprofitable. In other words, you can have a business which is profitable across, say, 10 sectors, right? You might be vertically integrated in some business, and you could have 8 or something of those sectors being profitable, and you can support others. I mean, in fact, that's essentially how R&D works in any business. You'll have an R&D department, and that's what it's for, research and development. It's not there to make money. It's there for you to generate ideas and to bring about something that can add to your existing business models, which might make them more profitable. But in and of itself, it's not a profitable business line. And that's essentially where AI is fitting into the space. So I'm not sitting here saying that the hyperscalers, for example, are not profitable. What I'm saying is that the component of AI is largely a drag on their profitability. That being said, you wouldn't see that if you looked at the share prices, because there's so much capital getting poured into these companies, and it's not just the hyperscalers; it's the chip manufacturers and yada yada, the whole big ball of wax. But there's huge issues with this. My buddy Cuppy's written some excellent articles, and people can go and have a look at. He's written some of the articles on that. But the point is that you have huge capital expenditure into things like chips, and the profitability from that is not there. And you could say, oh, well, that's okay. On a growing business, you're getting market share, and at some point you turn it into profitability. Fine. Okay, but that's a risky business model. That's essentially venture capital, or actually, yeah, it's venture capital. Now, the issue that we have with this is that if you pour capital into something that is capital intensive, but it's infrastructure related, or it's something that has longevity. In other words, like think about railroads, right? So you had the railroad boom, and you had tons of capital that went into railroads. It didn't make sense in terms of the profitability that could be generated from the railroads. But you had a mania, and everybody was like, "Oh, it's the railroads," and they threw all their money at it. Okay, fine. Yeah, people lost some money, but you know what you were left with? Railroads. You were left with railroads, right? So you could still build an economy, and you could still build the business models on the back of the infrastructure that had been laid. And that's been true of many of the booms in the world, whether it be the railroads or whether it be the internet. I mean, this is a classic Global Crossing. Do you remember Global Crossing? The guys who laid all the cables. Okay, that never made sense when they were doing it. It never made sense in terms of the valuations of Global Crossing and what they were doing. But of course, you had a mania, and people thought that trees grew to the moon, and they poured capital in, and it allowed for that infrastructure to be laid. Ultimately, it all collapsed, and then those assets were picked up for cents on the dollar, which is also why you and I are talking today over the internet at a fraction of the cost, because the assets, the underlying cables and all of that, were written down to cents on the dollar. So now if you went and you bought them, you didn't have that overhead of leverage. You didn't have the overhead of the original capital cost, but you were left with the cables. You had something to build on. AI, you're not left with anything. Why? Because the chip's obsolete in 3 years. So we're pouring tons of capital into quote unquote infrastructure, which obsoletes in 3 years.
Interesting.
That's a huge, and it's a revenue-free business model. Anyway, I don't know how this ends. I can suspect that there's ways that it can end, and it certainly is has played a decent part in why in our fund we have, and in the insider publication, we've mentioned this and given people details on how to do it, is we've taken out some put protection on that, which we've done, I guess, a month and a half ago, something like that. And it's just insurance, right? It's the vol pricing on those was pretty low. It's gone up now because the market started to turn. We'll find out whether our timing was good on that or not. But protection against that downside makes a lot of sense to us because you have such a massive concentration of capital that's been going into Mag 7, and we can talk a little bit about how that actually works because it's important for people to understand because they're just seeing price movements and people see price movements going up and they go, oh, Nvidia's going up or Apple's going up or Google or Microsoft, whatever it is. So what is happening is that there's passive capital flows, and those passive capital flows are not thought-driven. They're algo-driven. My friend Michael Green has written and talked about this extensively. And it's I don't know if or how it ends, but I suspect it ends at some point because what happens is pension money, for example, people put their monthly amount goes into their pension, their 401k or whatever. That capital goes in. It gets allocated towards your large, it's Vanguards, it's State Streets, it's Fidelities. And these guys all run these passive funds, right? Where they're just charging you 85 basis points or 1% or whatever it is on a structured product. Those structured products are algo driven. And they basically are saying, okay, allocate according, they're often saying allocate according to liquidity and according to market cap or market cap weighting. In other words, put the money into the S&P 500, for example.
Yeah.
And put it in on a market cap weighted basis. So now if the market cap of, say, Nvidia goes up, it says that this is less risky, right? Because you now have more capital, there's less liquidity. So liquidity is often associated with risk. Now, liquidity, which is wrong, liquidity is associated with volatility. But volatility is not risk, it's just volatility. Okay, you can have, if you have massive volatility and you have leverage, that's risk. But that's not the same thing just as pure volatility. You and I could have a company and we own 50 shares each. Okay. And we sell 10 shares and we have no leverage in the company. And the participants who have bought the 10 shares buy and sell those shares. Very, very thin liquidity. The pricing of those shares can drastically change. Okay. Does it change our business? We got like 90% of the shares. We're not going to do anything. We're still profitable. We're doing what we're doing. It doesn't matter to us. But that doesn't mean that the price of those shares couldn't change wildly depending on any number of different factors. It could be the number of buyers. It could be someone just gets a windfall payout and they want to spend fucking twice as much as whatever. There's huge amounts of potential volatility. So volatility is not risk. If we had a whole lot of leverage, then that's risk in and of itself. Now you can have shares attached to that, and volatility can cause risk where we're leveraged. So what you're seeing is basically all these metrics that get put down, which aren't necessarily always true. Volatility is one of them. Volatility gets dampened by additional liquidity. And so then they say, well, liquidity is a positive force, right? So we have more liquidity, that's less risk. Let's allocate more capital to the companies that have more liquidity. So then more money goes into Nvidia. And as more money goes into Nvidia, and I'm just picking on them, so don't, for listeners, It's not just Nvidia. More capital goes into Nvidia. It has more liquidity. Then the algo says, oh, this new ratio of liquidity has increased. Therefore, it has lower risk. Allocate more money. and it just keeps in a fucking circular fashion. So each time the capital goes in, it causes it to turn around and say, this is less risky. And then more money gets allocated as a percentage as a consequence. But guess what's happening? It's more risky. Each and every time there's more capital going in, it's more risky. I mean, this is how you get Palantir at 450 times earnings. Like, really? Okay, so now, I don't know when that ends. Michael Green has some assumptions on how that could end and so on and so forth. But what we do know is that concentration in markets, and this is true in nature, leads to dispersion always, and dispersion itself ultimately then leads to concentration. It's just think of a wave. So a wave builds, it concentrates, builds up, and then it disperses. And then the dispersion slowly comes together and it builds up, and you have another wave, and it concentrates and it disperses. And this just keeps happening. Now, of course, in the ocean, you can have maybe every seventh wave. Surfers can correct me on this. Is a bigger wave than the previous ones, and every now and then you might have a tsunami or whatever. But the point is that concentration leads to dispersion, and ultimately dispersion leads to concentration. What we look for in our portfolio is we look at once things have dispersed, and they basically, everyone's like, oh, it's fucked, it's done, the wave's crashed, it's never coming back. And it's like, it always comes back. So now we can go and we can buy those assets for cents on the dollar, because everybody's just got smashed because the wave crashed. On the contrary, when you see that concentration, you either stay the hell away from it, or in this instance, we have I wouldn't say a fear, but there is a possibility that as this wave crashes, it can bring down other sectors as a consequence of liquidity. And I don't know what level of interconnectedness exists in the markets, i.e. credit default swaps or any other derivatives built on the back of these existing assets, which we deem to be overvalued. I don't know exactly what that looks like. In other words, we could have a situation like 2008, which was liquidity driven and everything got smashed. Or it could be like 2000, where in 2000, if you were not invested in the dot-coms and in the internet stocks, you were fine. You could have invested in value stocks in 1999, and come 2003, you were fine. Didn't matter, because you were not invested in the stuff that was overvalued. Now, there wasn't a liquidity-driven event on the collapse of the dot-coms. It was more concentrated. What does the next one look like? I don't know. Hence, us going and taking put protection against that crash. So most of our portfolio is not invested into that. We're quite comfortable with that. But we've gone and said, okay, hubris is the most dangerous thing for an investor. I'm not going to pretend like I know exactly what any outcome is like. I know what's cheap, I know what's expensive, and I know how to manage risk. And so this is a measure to doing that. And certainly the pricing of that risk when we took out those positions was very cheap. We essentially dust 5% of the portfolio over 2 years, 2.5% a year. And if the NASDAQ falls by like 40%, that turns into 45% position sizing in our fund. That's a decent fucking parachute, right?
Yeah.
And that's not to say the rest of the portfolio might be fine, might go up. I don't know. But so these are some of the things that we've just been involved in over the course of the last few months. There's a whole lot of other things too, but we haven't spoken for some time. So there's a little bit of an update.
That's interesting stuff. The capital rotation cycle, obviously the loss of trust, right, in the world, everywhere. I mean, that's been going on for a while, and it just looks like the lack of trust now of almost everybody, top down, but from the bottom up, from the top to the bottom. So a lot of folks are going to gold, not trusting the existing system anymore. What I find interesting that you mentioned too, the AI companies that are not revenue driven, it's almost, it almost sounds like the Amazon story, almost. where I don't think that they were profitable for until the government kind of stepped in. So is that something that you're seeing there too, that there's going to be contracts and integration there, and that's eventually where they become profitable, maybe after it all falls apart?
So, look, I'm not sitting here saying that the market's going to crash. I'm saying that there's high concentration. High concentration is risk. If I can mitigate risk for cheap, I will. And so this is insurance on a house. If you bought $1 million house and you can insure the damn house for like $500 a year, why wouldn't you?
Yeah.
Okay. And again, it's not like I'm saying the house is going to burn down. I'm saying that the risk to the house burning down is higher than it has been before. So that's just an intelligent move as a fund manager. There's any number of things that I guess could prop it up. Governments could deem AI to be of national security importance or some bullshit. Okay.
Yeah.
And so they can then force capital, which to some extent they've done in the bond markets anyway. Oh, it's so risky. Let's make sure that all pension funds are safe. They've got to be safe, mate. How do we make sure they're safe? Well, let's make sure that 30% of the capital has to be allocated into government debt securities because that we know is safe, okay? Things of that nature. So now you distort the market. The issue with doing that is that you can't distort one thing without distorting another. So the moment you go and you distort the debt markets to that degree is the moment that your currency comes under pressure. You can't take long-dated security and artificially elevate its price without simultaneously deflating the short-term value of that security, i.e. cash, right? So this is why you see gold moving. Because it's like, why the fuck would I own government debt at 4% when I can see that your deficits are exploding and you can't meet the interest bill, so you're going to print the money to pay the interest. And so the short-term value of that instrument, i.e. cash, has to go down. It has to cause inflationary or stagflationary impact in the market. So there's any number of ways I can play that. The easy one is just to say, fuck it, I'll own gold. But inflation can be played in many other sectors. The point is that they can distort one market, but they can't do so without distorting another. So can they support AI and can they prop up this bubble? Sure, they can, but not without distorting other markets. So that's where you need to try and figure that out to some degree. What I do believe is happening now, and it comes back to Michael's analysis on this, which is that the bubble that has been created has been as a consequence of passive capital flows. It's not necessarily that there's some nefarious characters there saying, hey, we're going to push money into this, that, or the other thing. It's structural in the market. And if you look back over the last 40 odd years, individuals like myself are now a rare breed. In other words, active fund managers who are active, who literally sit there and think about things and make active decisions, as opposed to a bunch of marketers with a back-end black box system, right, which is algo driven and decides how to allocate capital. That's where much of the capital in the world has shifted to. If you go back to the 80s, a lot of capital was managed actively. Now, very, very little amounts. And so what that has meant is that the entire business model of investment has changed. It's changed from, for example, the 2 and 20 model, 2% management fee, 20% performance fee, which is performance driven. So for example, with Glenorchy, we make money if we make money. If we don't make money, we don't make money. But by and large, and what I mean is we have to have performance, otherwise we don't make any money. That's because we're small. We will always be small. A few $100 million. I know we could get to, maybe $500 million. It's still going to be, that's relatively small. that's very different as a business model to your Fidelities and your BlackRocks and your State Streets and your Vanguards and these guys. They manage billions and billions of dollars, and their model's quite simple. They don't really give a shit about performance. It's about aggregating capital under management and charging a basis point or two on that. They charge on multiple levels. They'll have the ETF, for example, or of what is essentially the S. Mate, I can't tell you how many funds I've looked at, which are literally just the S&P, but it's a lipstick on a pig. They've changed a little bit here and there, and they've now called it some other thing. And then they charge 85 basis points or a 1 basis point on top of that. So you have this structured vehicle that says, oh, it's like, the blah, blah, blah ETF or whatever it is.
Aggressive income ETF.
It's by and large the S&P 500. And by the way, we saw this with the whole ESG nonsense, which is now being washed away. Our ESG fund. And I remember having a call with an institutional group that wanted to or were looking to invest with Glenorchy. And the moment I opened my mouth, I knew they would not invest with me. I knew they wouldn't invest with me because I was going to tell them the truth. And the truth was this, because they asked us about our ESG scores. And I opened my mouth and I told them that ESG was a scam and it was a fraud. And I showed them the ESG fund, right, which was essentially the S&P 500 attached with an 85 basis point clip. So I said, you're just paying 85 basis points for the same goddamn thing, except now they put an ESG wrapper on it. They just called it that. So it's a fraud. And they're like, but what's your ESG score? Anyway, so the point is, you have these things wrapped up. Okay, they charge like some fee on that. And then they say, okay, come into our fund over here, which then invests into that. And they charge another 100 basis points or whatever. Often you're paying up to 5% on this shit. People don't even see it because it's structured products, all of which are just flowing into, again, as I said, passive capital, but they're not caring. They don't worry about returns. Just aggregate as much capital in, clip the ticket, and you can live on the 7 golf courses around the world and have a great life. That's what they do. So, but that business model itself requires large pools of capital, right? They can't do that model on $300, $400, $500 million in assets. Okay. So without a performance fee, but they don't care about performance. So all of this capital just keeps washing into these funds, and that again gets allocated on a basis which is essentially liquidity driven, market cap weighted, and it's algo driven. So that's where we're seeing this massive concentration of capital going into the Mag 7 and so on and so forth. So if that stops, in other words, if you get a strong recession and the pension money, people go, oh, I'm not putting money into I can't afford it this month. Do the algos then turn around and go, oh, there's less liquidity in X, allocate less? And the cycle reverses. Now you got a problem.
It flips. Yep.
Now you got a problem because with many of these things, they're, like I said, they're revenue free. It's not like back to the situation where I said you and I got 50 shares each and we got a profitable business. Our other 10% of shares we sold off, they can be volatile as hell. People can buy them and sell them. If we are profitable, we don't care. We're going to hold the stock that we own. We're not selling it. If something becomes available and it's super cheap at some point, we go, oh, we'll buy it back. How? With the revenues, with the profitability of the company. A lot of these companies don't have that profitability.
No, it's a very interesting. Chris, what's your take on some of the things happening in the repo market? There's certain folks that have looked at that. There's similar action that they saw in 2019 with it freezing up a little bit. What are you seeing there?
I don't know. I haven't looked at it closely. I've looked. I think Ben Ricketts been paying some attention to that. There's a bunch of like folks far smarter than myself. Certainly, well, if we go back and we think about the repo crisis, which actually preceded COVID, the freezing up of the gilt market, and the massive need to inject capital into the bonds to help shore that particular bloated pig up, there's a very strong argument to be made that we saw COVID as a consequence. It's not like COVID. We know COVID was a complete, utter sham and scam on multiple levels. Be that as it may, that was very timely in terms of propping up a market that was in collapse in the bond market. We are seeing similar stresses in the markets today. Does that mean we have COVID 2.0 around the corner? I don't know. But there is a problem there from what we can tell. But this time is this. Yeah, I don't think they get to pull the rabbit out of the hat in the same way as they had before. This time would require far greater levels of totalitarianism. Why?
Which
Because
it started to
people
raise his head, right? That kind of especially in the West.
yeah.
You look at the United Kingdom, other countries in Europe. It's actually quite shocking to see some of the things, people getting arrested for posting on social media. So it's interesting.
It's not even in a point now where you could sort of go, oh, well, that's a bit of incompetence and it's a little bit odd, or it is unbelievably, absolutely, totally blatant. You've got, I saw just the other day, some Muslim cleric sitting in Trafalgar Square, standing on a mount, basically declaring the end of the West, and that we should, the Muhammadiyans need to take over, and that it's perfectly fine to slaughter the infidels. And he's left there, and there's police just watching him. And then there's another incident of a Christian evangelist who's not calling for genocide or anything of that nature. He's just standing there on the side of a road, telling people that God loves them, and he's arrested. Many examples, but no, in my opinion, and this pains me to say it because I spent a number of years in the UK, and it fairly close to my heart, as it is finished. There's huge issues for the UK, massive issues, Europe in general as well. I don't see a future for Europe that does not involve either a consolidation of power, which will at this point require huge tyrannical force, or a fragmentation, a splintering, and civil war. I can't see those are the two outcomes, and maybe you get both to some degree. And so in that world, it's also interesting because, like it or not, the US stands out as a better conduit for capital. Now, the US itself, as you know, has significant issues, but on a relative basis, at this point in time, it's better. That's just in terms of global liquidity. Now, I don't have to play that game. Why? Because if you're like sovereign wealth funds and you're managing frigging hundreds of billions of dollars or anything of that nature, you're looking for relative liquidity. So you're playing that game. You can't necessarily go in and invest into like Norwegian kroner or, I don't have to play that game. So we hunt where there is deep value. It's why we've been buying places like Argentina. We can go into emerging markets. We can go into the places that don't have the same depth of liquidity because we're small and nimble. And for your listeners, you're in the same boat. Not likely, you almost 100% are. I'd be very surprised if you've got listeners that are, sitting on hundreds of billions of dollars. Dreadful. Or even billions. So, but that's, that's the weird setup that we've got in the world today. And it's just a matter of trying to manage that risk. But there's a lot of opportunity out there. Gosh, there's so much opportunity as these things start unfolding. I mean, we're seeing it in China. I know people are like, oh, they hate the Chinese, and it's worth going and having a look, and actually seeing the difference between propaganda and reality on the ground. And I'm no fan of the CCP, so people don't come out. But the reality is that people will default to that propaganda and be like, oh, you're a Putin lover or a Xi lover or whatever it is. Look, the world's run by psychopaths. All of them do not have your interest in heart. All of them. Some to a greater degree than others. But certainly the very idea that you living in your quote-unquote democracy is better fails in the front of experience. You don't live in a democracy. You live in a world where people with far more wealth and power decide who gets put in front of you so that you can elect them. And then they follow the orders of the people who put them in front of them. That's what happens. It's not a surprise. It shouldn't be a surprise. Because why is it that the people that you elect come out and they do the very opposite of what they said they would do? You don't have accidentally open borders. You don't accidentally hand out checks to fighting aged men coming across your borders, putting them up in 5-star hotels. That's not accidental. That's deliberate.
I have someone in my network too. It's interesting, when you talk about democracy, you talk about this, and to your point, the world's run by psychopaths, and he's been in Dubai for a while, which I know you've checked out Dubai quite a bit. There's a lot of things going on there, but it's interesting where it's like, well, you have a sheik running it, but no income taxes for them over there, and a lot of other things. So he's like, well, would you rather go and vote and pay 40% in taxes, or decide who gets it and how your money gets spent, or you have this type of setup here? Because to your point, they're all psychopaths.
The reality is your vote doesn't fucking matter.
Yeah.
Right? I mean, yeah, the democracy of the world, America. You voted for Trump. Trump, who promised to release the Epstein files. Has he? No. Trump, who promised to shut the borders. Has he? No. I mean, there's a lot of propaganda saying he has. But I was just down in Texas. There's like, it ain't what the media are saying. Now, he was going to stop wars. He's just given another $40 billion to Ukraine. On behalf of his Israeli handlers, he's busy bombing Iran, and he's giving more and more money to them so they can genocide the Palestinians, so they can create Greater Israel Project. At some point, you have to be literally retarded to think that this guy's working for you. And it's not a particular to Trump. You think Starmer works for you? Macron? None of these people work for you. And the idea that you're going to find someone else that you're going to put in power that's going to change the dynamics, that doesn't work either. There was a very interesting interview, I think it was from 2012 or 2014 with Putin, and he was being interviewed by two folks from, I think it might have been the BBC. It was a UK journalist. Interesting interview, but during the interview, he talks about the way things work in the West. And he said, look, why is it that your politicians say one thing and then when they get into power, they do another? And he said, I'll explain to you what happens. It's not necessarily that they're bad guys. What it is, they might be very true to the ideas that they put forward. But once they get into office, they sit there. And he said, two gentlemen in black suits will arrive, and they'll sit him down and they'll tell him exactly how things work. And that's why things don't. So all he was referencing was the deep state. which runs and controls things. People have talked about APAC, for example. That's just a tiny element of it. The interconnected, nefarious deep state runs and controls things. So the podium donuts that you have in front of you, who will say the things that are required for you to elect them, are saying they're either saying those things in order to be elected with zero intention of implementing them, or they actually believe they're going to implement them, but once they get into power, the two guys with black suits turn up and explain to them how things actually work, and they realize that that can't happen and won't happen and never does happen. Either which way, you electing these people is a complete waste of time. So, back to the story. Do you want to live in a world where it's much more transparent? Say Dubai. You know that you don't disagree with a sheikh. Singapore is not a democracy. I was just there a month ago. It functions. At least you have some level of safety. Now, again, I'm not a proponent. I'm not sitting here saying these are the best places on earth. I'm just saying on a relative basis, because everything's relative. I'm a fund manager. I have to make risk calculations, and I don't live in a perfect world. My perfect world would look very, very different. Trust me, but that's not the world we live in. So be it. I got to deal with what you got. But you have relative economic freedoms in Singapore, Hong Kong, Dubai.
Right.
You don't have any political freedom, but you think you got political freedom in Britain, France, United States, Canada? In Canada, they're busy taking people's property away under the guise of original native title ownership.
Yeah, things are turning quite quickly to the north of the United States in Canada. That is an interesting place to watch right now, between all of the, assisted suicide programs, or what's that? The medical assisted. Yeah, it's a very, very interesting place to watch right now.
It is.
Yeah, Chris, this has been great to catch up. I love the content that you put out at Capitalist Exploits. I love the humor that you add to the craziness, because you have to. You keep it very entertaining, and always put a spotlight on all of the massive opportunities that's out there. Because the world's so crazy, there are so many opportunities. So where can folks give you a follow and just subscribe to your newsletters, and then just stay in touch and just see all the many different projects that you're involved with?
So our publication is found at capitalistexploits.at, and our asset management business for folks that want to be invested in our fund or in our asset management strategies, that can be found at glenorchycapital.net. That's it. So you can find
awesome. Me. Yeah, thank you so much again for coming on the show and always providing so much value. Appreciate you.
You're most welcome. It's good to be back, mate.
And thank you to all of my listeners and my viewers for again spending your most valuable resource, your time, once again with me on the show today. Everything Cashflow Ninja is at cashflowninja.com. That's cashflowninja.com. We've got over 1,000 podcasts, 4 books, reports, webinars, and much, much more, all at cashflowninja.com. And don't forget to subscribe to the #1 newsletter in the alternative wealth strategy and alternative asset investing space, the Wealth Dojo. You can subscribe to the Wealth Dojo by going to cashflowninja.com/subscribe. Until next time, live infinitely. This presentation is for educational and informational purposes only. The information being presented and considered does not consider your particular financial objectives or situation, and it does not make personalized recommendations. This material is not intended to replace the advice of a qualified tax and legal advisor or other qualified professionals, and you should not use the information in place of a customized consultation with a licensed professional regarding your specific personal financial objectives, situation, and needs. We believe the information provided is reliable, but we do not guarantee its accuracy, timeliness, or completeness.